Good morning, good afternoon, and good evening. We'll focus on exam questions, that is in financial management and corporate finance. And I think I'll be coming live on this particular forum every day. I think so. I hope I'll manage. So let's first look at the second question. I know the first question we looked at it. Let's look at the second question and see how best we can manage it. Doreen, I guess we looked at this question last time. You looked at it, I guided you. So we can go to part 2. Where you don't understand, please just comment in the comment box. I'll be able to even pick a phone and talk to you and just to guide you properly. So we look at this question. It states, it reads, a company is considering an acquisition of a machine for 80,000 kwacha, which will save cost of 20,000 kwacha per annum for 5 years and will have a resale value of 10,000 at the end of the year. At the end of year 5, the company's cost of capital is 10%. Is work. So let me just open my Excel. So we have been told that this particular investment costed 80,000. But if we leave it like this, we would have assumed that this capital outlay was a cash inflow, and yet it was an outlay. It was a cash outflow. So we'll actually make it a negative. Then we've been told during commercial operation, this project managed to save 20,000 kwacha on an annual basis. So we'll type 20,000 like this. Then we are actually told in the 5th year, at the end of the project, when now they were decommissioning the project or de-recognizing the project, they managed to sell or to salvage a 10,000 kwacha. That's it. So we can now do the computations. First, we'll have to find the cash flows. This is what we have. But then we've been told that the discount factor was or is 10%. This discount factor is influenced by inflation, is influenced by interest. It could also be influenced by the equity returns. In getting this discount factor, behind the scene, they could have actually used WACC and CAPM, capital asset pricing model. So we bring the discount factor at 10%. So what do? In year 1, the discount factor is, in year 0, the discount factor is going to be 1. Why? The money that you have in the pocket today For example, if you have 1,000 kwacha, what's the value of that 1,000 kwacha? Now it should be 1,000 kwacha. This is why you're putting a 1. From year 1 to year 5, we expect that the 1,000 that you have today, if you are to have it at the end of the year, you have to discount it today so that you make a decision today. So this is what we do. You don't need to stress in getting these numbers. In the exam, you'll be given the present value tables or the annuity table. So you should not worry. But all the same, we can do like this. This is 1 divided by 1 plus the discount factor here. And this should be 0.909. I still know this. So this is what we do. If you have a calculator, you just pick that number that you have already calculated, divide by 1.1 plus, which is 1.1 plus the discount factor here. So then now we can get the present values, guys. Multiply that times 1 here. So meaning that the present value would be, you ignore the initial outlay in year 1. This will be your present value. Your NPV would be, you can now sum everything from here to there. But what does the question say? Let's go back to the question, gents. Gents and ladies, let's go back to the question. We are actually being asked to calculate the NPV, which we have already done. But then we also need to calculate the internal rate of return. I'll need to explain something on the internal rate of return. Internal rate of return, ladies and gentlemen, it is basically the equity return. In short, you can even say it's the break-even point. This is the point at which you are having a 0 NPV. 0 NPV, it does not mean that you have 0 cash flows. No. Remember that your future cash flows have been discounted. But when you discount them, it gives you 0. But the real cash, if the plan could go by, if the plan, your plan comes to fruition, you will still have cash. It doesn't mean that you do not have cash. You have cash, but if you discount it to today to actually check the value of that money, you will have 0. So it is the break-even point. Meaning, if, for example, you find the internal rate of return of 15%, what does it mean? What it means is that if the cost of equity or the discount factor, the cost of money goes up to 15%, you would have break even. But if the cost of capital cost of money goes beyond the internal rate of return of 15%, you start getting into negatives, which is dangerous. At that point, the investment is actually going to be useless. So we want to know at what rate are we going to have a zero APV. Okay, now continue, guys. So what do we do? Internal rate of return equals the discount factor 1, which is that 10%, plus, I'll do like this, NPV 1, which you have found there, divided by, maybe I'll do like this, divided by NPV 1 minus NPV 2. Once you get these numbers, I hope my body mass is okay in there, but do not mind, times the difference between discount factor 2 minus discount factor 1. This is how the formula is. But if I was using Excel, which I know you guys are not doing modeling, if I was using Excel, for those that would want to use Excel, for those that are also doing modeling, I would do this. I would say these numbers. This is what I would get. This is what I would get. As easy as that. But we have to go the hard way. We have to go the hard way. So we are going to call this as NPV1. We need to find the, using the same thing, we have to replicate this table to there and get another discount factor. I always recommend that you use 20 for your you use 20%, the last number on your table, on your present table. So here we would say, instead of that number hitting there, we'll pick this number here. Same. And move this to here. Copy. Paste the other side like this. So meaning NPV 2 would sum these numbers a negative. This is what we wanted. So here we have NPV2, which is this number here. Right? Now we'll have discount factor 2 minus discount factor 1. I'm just arranging these numbers correctly, which is 20 minus 10. We know it's 10. But I want to show you that this is how these numbers are coming in. Then here, I can still calculate NPV 1 minus NPV 2, which is the positive here minus the negative there. It should give me the positive. Having done that, I have now these numbers. I can do my internal rate of return easily. So I'll start with my discount factor 1, according to what the formula says, plus, I would open it like this. I would go to my NPV 1 divided by NPV 1 minus NPV 2, which I have here, I'll do like this, but I need to respect BODMAS, guys, times the discount factor 2 minus discount factor 1, which is this. This is what I would get. See, this is the 11%. So if you wanted to be very precise, it doesn't matter. You could even do like this. It doesn't matter. But this is not as accurate as this one here. This one here, it is very accurate. You find it to be around 10.9 or about like this. So you can see this one is very accurate. This one is a trial and error. You run so many trials, not really error, I don't know, but you're doing trial and error in a way. Any questions up to here? Any questions up to here? Now we'll go on to look at profitability index. Profitability index, ideally, it shows the attractiveness of the investment or the project that you want to undertake. It tests, not really it shows, but it tests the attractiveness of the investment that you want to undertake. It's easy. It's all the present value numbers divided by the initial outlay, comma, that's it, finito. Let's look at it. So we are told calculate the PI of the project, calculate the profitability index of the project, but I've already told you what this formula is. Sorry. So part 2, or rather put it here on top. So I'll say here I was answering maybe number 1. So we answered this on NPV. So number 2, profitability index. This basically, it is actually testing the project attractiveness. That's what it is testing. Anything NPI that is greater than 1 is attractive. Below, obviously, it's not attractive. The formula is easy. Is the present values divided by initial outlay. So in this case, the PI would be equals the present value here divided by 80,000. I've put absolute to change it from negative, which is 1.3. So this is what it is, and this is what we have here. That's the second part of this question on PI, profitability index. We then go to the last component of this question, which is on the accounting rate of return. Accounting rate of return, others would also call it return on investment, ROI, or it could also be a proxy of ROCE, return on capital employed. All you have to do, you have to convert the cash flows if the question you have are it's actually you've been given cash flows, you have to convert the cash flows to profits. What you have to do, you have to subtract your depreciation from your cash inflows to get profit. Again, there are times when the examiner would actually give you in profits numbers that are basically profits and not cash flows. At that point, you have to add back depreciation because depreciation is a non-cash item. So in this case, we know that these were the cash flows. We had, okay, let me go to C. RR. So accounting rate of return, guys, is average profit divided by average investment. This investment, guys, it's a midpoint. You find the midpoint. So it will be your investment divided by 2. This gives you average investment. So in this case, we have 80,000. What have we been told on the 80,000? To get depreciation, we'll do like this. Depreciation would be your investment less scrap value or residual value, whichever way you want to call it, divided by the number of years. So we'll have 80,000 80,000 minus 10,000 divided by 5. This gives us a depth of 14,000 kwacha. So from here, all you have to do, which should make your work easier, is 14,000 is, I'll give you an easier way. You don't even need to do this. You just have to say 80,000 minus 10,000, it takes you to 70. Or you can say 14,000 times 5, it takes you to 70. But in the exam, just say 80 minus your scrap, you get your depreciation. So your depreciation is your investment less scrap. So this is accumulated depreciation. I should call it accumulated depreciation. So accumulated depreciation is investment less scrap. So meaning you don't need to waste time. So you have 70,000. But then you've been told that your cash flows, it's how much? Your cash flows is 20,000 times 5, which is 100, minus your accumulated depreciation of 70,000. We'll do this, so there's no need of 70,000. I put a negative here, meaning for sure meaning that your profits this is for the whole project. Would be this. This is for 5 years. 5 years. But then you are interested to find the annual. I made a mistake here. I should have called it annual average. So your annual profits. So your annual profit, this is average annual profit, is 30,000 divided by 5. This is average, which is 6,000. But then your average investment guys, is, let me do this, is your initial outlay, or let's just call it investment. Investment is investment. Your investment plus your scrap value or resale value, because that is your investment, what you sold at that time, what you expect to sell because you make some cash inflow. That is your investment. So divided by 2. So in short, here your average investment would be equals your 80,000 plus your 10,000 divided by 2, which should give us 45,000. So your average rate of return, guys, would be your average annual profit divided by 45,000. This gives you 13%. If the ARR is greater than the cost of capital, let me do this so that you know how to interpret these things. If the ARR is greater than the cost of capital or discount factor, meaning that the project is okay. Otherwise, it's bad. In this case, you have your cost of capital. Sorry. You have your cost of capital of 10%. So it's okay. Thank you so much. See you next time. Bye-bye.